Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. During today's show, I've been talking about investment noise and how to deal with it. It's probably one of the most corrosive effects that I see on people's portfolio, not just on their portfolio, but their attitude in general, is paying too much attention to the bombardment of information. And I know it's kind of funny because you're probably listening to this on TV or radio or on the internet, but we want you to listen to this show because we try to give you information that's usable and hopefully timely, things that you can use in your portfolio, in your life, that are going to matter. A lot of the information that we get, especially in the financial world, is just not relevant to anyone that is a long-term investor. So we started talking about it. I mentioned a book called Before Happiness by Harvard educator and speaker Shawn Achor. And he examines the link between cutting the flow of irrelevant information and the increased likelihood of reaching a goal. And as you can imagine, he finds that cutting the flow of irrelevant information significantly improves your chances of achieving some goal and, as a byproduct, enjoying a better life. And so that's what we're talking about here, is investment noise and information. I hear so many things on a day after day basis from people, and not to be critical, but they just don't know any better, and they say, well, did you hear about this? Or, did you hear about that? And yes, and that's just, it's noise. It's irrelevant. The majority of information is noise. One of the favorite things I like to do is look at managers or certain funds or people's strategies, and they say, well, look at this strategy. It's outperforming, the S&P 500 by 2% over the past year. Oh, really? Statistically, that has no relevant information in it. I've used this example before, but in the drug world, they do drug trials, and they don't give this experimental pill to 2 people and find out if it's going to work. They give it to people that are 18, they give it to people that are 65, they give it to men, they give it to women, they give it to healthy, they give it to sick, different races, everything, just to get a good sample set to figure out if this thing is going to be safe. Well, it's the same thing in investing, is that most managers and most funds have not even been around long enough to draw a statistically significant conclusion. I hear this one all the time. Well, we called the 2008 decline. And, I have to say that at our firm, we were very fortunate to avoid most of that, but I certainly don't attribute that all to skill. I mean, there's no way you can take one event, somebody that says, oh, well, we called the 2008 crash. You take one event, and you cannot ascribe any statistical significance to that whatsoever. It's a huge mistake that people make. Okay, so back to the 4 filters we want you to process. Number 1, we want you to think about that information and say, is it usable? Is this information can I incorporate it into my long-term investment strategy? Number 2, is it timely? Is it some piece of information that is going to change in the next 5 seconds, or is it going to change in the next month? Like the unemployment number. Is that usable in your portfolio today? Or, are you glued to the TV waiting for that latest unemployment number to come out? Well, trust me, it's going to change next month, and next month they're also going to revise this month. So the number that comes out, other than people running around, trading, it's useless information. Okay, so let's talk about the third thing. And is it a fact, or is it some sort of hypothetical theory opinion? So we want you to deal in facts. The most common noise is based on what someone will think will happen. So you get people on TV and they say, well, the Fed printing all this money is going to cause interest rates to rise. It's going to cause inflation to rise. Now, I may tend to agree with that, but that is a hypothetical. They don't know that. In fact, if you've been listening to this show or reading the stuff we've been writing, and people were panicking earlier this year, the bond market had gone up a little bit, the 10-year Treasury was over 3%. So don't panic. This has happened before. And sure enough, interest rates dropped from 3% on the 10-year to about 2.5, 2.6. And so you've got to be very cautious about hypothetical predictions, especially in the short term. Now, the long term, someone, you come into our office and you're not saving any money and you're spending, $200,000 a year and you want to retire in 5 years, and we tell you, well, no, that's not possible. That's not hypothetical, even though it is our opinion. More than likely, unless you win the lottery or something, it's not going to happen. What we're talking about is people that go on there and they're sure of themselves. The euro is going to collapse, or emerging markets are going to take over the world. I mean, these are all things that you hear. I love going back, and there's some archival capabilities, or look at old newspapers and things like that, and just look at some of the old headlines of things that came to pass. So you want to make sure that you understand if people are dealing in the hypothetical or in facts. Even if the person is right, it doesn't mean that information was usable. We see people making predictions all the time, and so people are bound to be right sometimes. So the last thing we want you to filter from is that information distracting? Jim Cramer, I hate to pick on the guy, but he's loud. He shows loud. It's noisy. He's got bells and flashing lights, and it's distracting. And he's trying to distract you to watch the show, but reality is it can tend to distract you from your long-term goal. Looking at the latest and hottest new fad and things like that. I mean, that's kind of what we do, is we process, these new investment strategies that come through and a filter. And sometimes individuals don't have the ability to do that. After 2008, the crash, everything that's coming out today is all about downside protection and guarantees and things like that. And one thing I can tell you is that the next crash is not going to look like the last one. And a lot of these products and a lot of these solutions that people are just throwing out there are not going to be in your best interest in the long term. So be careful of the distracting, especially the ones that prey on people's emotions, the distracting information. All right, well, that brings us about to the end of the show. I didn't get to the healthcare reform. Maybe we'll do that next week, but you get enough information on that. I wanted to bring you some other topics. So just to kind of summarize, we want you to process the information that you receive from the media through 4 filters. Number 1, is it usable? Number 2, is it timely? Number 3, is it a fact or a hypothetical? And number 4, is it distracting? And if you use those filters, I think you'll come to make better investment decisions. Well, that's all for this week. We'll see you again next time.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.